Hi everyone, I am Mark Rubenstein. I'm Managing Director at Luminous Partners. We're a boutique advisory firm. We've got about 25 or 30 people, focusing predominantly on mergers and acquisitions, but also have had some fairly deep experience in the activism space. So looking forward to a very interactive discussion here. Why don't we start off with some brief introductions?
Afternoon everyone, Victoria Hardy, Head of Private Equity at HMC Capital. Part of my role is responsible for HMC Capital Partners Fund 1, which is our highly concentrated listed equities investment portfolio where we take a very proactive approach to our investee companies and take strategic stakes and look to create value through active engagement.
Good afternoon everyone, my name is James Hawkins. I'm partner and head of the L1 Capital Catalyst Fund. We are a best ideas fund with an activist overlay, 10 stocks only, long only, no shorting, no leverage, with an ASX 200 focus. We've been in existence now for 3 years and 3 months, and look forward to the panel discussion today.
Good afternoon all, I'm Danny Hunt, I'm Managing Director of Proxy at Sedali & Co. My colleague Roger Newby was on the previous panel, so hopefully he's given you a good overview of Sedali & Co. I don't have to repeat that. But I basically manage our proxy solicitation business for Australia, do a lot of work with listed companies in helping de-risk kind of voting outcomes, so strategic advice around shareholder engagement, shareholder analytics, and engagement with various stakeholders such as proxy advisors as well.
Hi everyone, I'm Vid Rangaswamy. I am the portfolio manager of the Tanara Long-Term Value Fund. It is a listed equities focused strategy, trying to take a private equity style approach to Australian public companies. We've been in existence for nearly 6 years now and have about $1.9 billion of funds under management and like James, focused on 8 to 10 positions at any given time.
Excellent. Thank you, everyone. And we will have some time for questions at the end. But maybe, Danny, if we can start with some statistics in terms of the scale of specialist investors or specialist activist investors in Australia.
Yeah, thanks, Mark. Before I go into specialist activist investors themselves, I think what's important to do is set the scene as to the current landscape, really. And I think, think about the listed company space and a lot of the challenges they're facing at this moment in time. There's been a huge focus on risk management and governance, as well as juggling various kind of macroeconomic conditions, cost of living crisis, inflation, geopolitical situations, and various others, numerous to mention, but things that boards and management teams having to manage simultaneously. And as to how well they're managing that is open to debate, certainly. But what we saw kind of play out in last year's AGM season, which has just gotten underway here, is that investors and various stakeholders are increasingly open to going against boards. Right, I think there were around 41 companies in the ASX 300 that received strikes against their remuneration reports, vastly surpassing the previous record in 2019 of 26 strikes, I think it was. And in addition to that, right, the remuneration reports, the easy protest vote. It only requires 25% of dissenting votes to vote the resolution down. But directors being up for election or re-election, again, saw a significant increase in the number of directors receiving more than 20% against votes as well last year. So this just kind of sets the scene for what is, investors, other stakeholders being very open to voicing their concerns or being openly against existing boards. In terms of recommendations they're putting forward. And I think that kind of sets the scene for opportunity for activism in Australia as well, right? There's already an existing unhappy shareholder base to potentially be tapped into by activist funds when they're seeking support for their proposals. So speaking of activism in Australia, I think the numbers say that in 2022 there are around 63 ASX companies that were targeted by some form of activism. That dropped a little bit to 56 in 2023. But these were public campaigns, right? These are 249Ds, 249Ns, the requisitioning of meetings, shareholder proposals being submitted. And so there's a lot that goes on behind closed doors in terms of activism, which is probably a bit more difficult to quantify. Not probably, definitely a bit harder to quantify. But I think that the point is that, you know, there's a lot happening in the activism space in Australia. You know, I think when we look at those public campaigns, 48% of all of the situations pertain to board composition. So, you know, attempts to remove directors or obviously put in place directors. M&A was secondary, but, you know, significantly lower in terms of a percentage of the whole thing. ESG as an area of activism, obviously growing in this market massively. We've seen the likes of market forces in ACCR, target companies, whether they be high emitters in mining and resources stocks or financial institutions that fund those emitters. You know, they're increasing their scope, and this year, for example, they're targeting Coles and Woolworths in respect to sustainable salmon farming practices, and not necessarily price gouging at this stage. You know, I think overall that just kind of sets the scene, right? There's an increase in activism. These ESG bodies, they're not necessarily investors, but they're activists. And to the point around specialist activists, you know, you only need to look at some of the names on this panel. A couple of others that refer to themselves as activists, like the likes of Sandon Capital. You look at a very small number of individual investors, but they manage, you know, $50 billion plus in terms of assets under management in AUD. And when you couple that with you know, the growth of superannuation funds, you know, they're increasingly becoming more active in their approach to things as well. And in instances, there are various examples like Australian Super and Origin Energy, where they've adopted an activist style approach to going against boards. You know, they manage 3.9 trillion. So the potential capital to be deployed across listed space to drive change is huge.
Great, thank you. I think when we're talking about specific specialist activist investors, if we're talking about a 50 billion type number, it's obviously a lot of dollars standalone, but compared to the overall market, I think the ASX 300 is 2.5 trillion. And be prepared for a pitch from each of them, but can activist investors really make a difference? Maybe we'll start with Vid.
Sure. I mean, I think our track record has shown that you know, we can and do have an impact at companies we invest in. You know, I think the broader question of, you know, can activism improve, you know, system-wide public company accountability and performance? Time will tell. You know, activism is still quite a nascent investment strategy in Australia. 6 years ago, you know, that there were almost a handful of investors pursuing it from a shareholder value lens. You know, today on the stage, we probably have just over 4 billion, closer to 5 billion amongst the three of us. And, you know, when you certainly look at other developed markets around the world, activism is a greater part, I guess, of the public equity debate. And so I've no doubt activism will grow in the Australian market, and hopefully some of the benefits of that improved public equity outcomes for everyone.
Great. James, anything to add?
The only point I'd add is I think what's interesting is the trend to passive actually assists what we do as activist investors, because if we own 10% of a company and there's 50% which is passive, if that 50% passive becomes 60%, just say, our 10% actually becomes a bigger percentage of the active part of the register. So I think that trend to passive, you know, is something which is going to benefit us, and it will also benefit flows into activist funds from a portfolio diversification point of view. You know, you've seen in the Australian market, you know, the last 12 months, really you know, significant divergence between the financials and the banks and how they've performed vis-a-vis, you know, many other parts of the market. And so what you get in investing in an activist funds, be it Victoria's, Vid's or mine, is you get you know, the opportunity to get, you know, some significant tracking error by design. And that's a unique place in the portfolio for the investors who invest their money with us.
Just one thing to add, I think the fact that we're talking about it and it's becoming an increasingly part of the conversation shows that it is having an impact. I think if it were just a fly you could swat away and we weren't actually making an impact, then I think that absolutely there would be no market for funds like ours. So the fact that it is a part of the discussion, boards are becoming increasingly aware of it and thinking about how they might respond, means that, you know, there is a part to play for really active investors.
And when looking at situations, I think the obvious place to look is where a share price is down 50, 60%. I assume that's not the only criteria that you look at. What else would you look at when you're screening situations in terms of where you would invest, where you can make a difference?
So we look for quality businesses that have traded off typically, where we can actually influence the outcome and there is a catalyst to unlock the value that we see. There are many situations where a stock may have dropped 50%, but we can't see a way to unlock the value, or there's not a clear path to a value unlock strategy. So we won't get involved in those sorts of situations. But typically we see management discount or cyclical factors or a conglomerate discount as the reasons why a number of companies might trade at a discount to fundamental value. And then we'll apply our special skills and networks to try and think of a path to improving the value constructively for all shareholders.
James, what do you do that's different?
Some similar, some different. Typically for our fund, for a stock to go into it, it must pass through 3 gates: value, quality and catalysts. We look for quality companies like Victoria. The valuation proposition needs to be compelling. And in respect of the catalysts, they can be of a strategic, financial, operational or governance related type. So it could be that we think a company can change its dividend payout ratio to increase the extent of the dividends which is paying out to shareholders. It could be to change the governance structure and increase the diversity of the skill sets on the board, or it could be something of a strategic nature, as was the case with, say, Tabcorp, whereby you had a wagering business which was decreasing in value, and an infrastructure like lotteries business which was going to be valued more highly by the market on a standalone basis. So what's really enjoyable about our type of work is every situation is bespoke. Every situation has its own idiosyncrasies, and there's no one type situation that is reflective in every type of investment.
Yeah, I mean, I think there's a lot of similarities between what we do and Victoria and James. We really come at it from 2 angles after we've sort of crossed the inherent quality of the company and the valuation piece. The first is really looking for suboptimal corporate structures, and so that can lead to things like asset sales or demergers or improved capital allocation. The second is operational turnarounds, where we see companies that we clearly believe are underperforming their potential, and we look to sort of embark on a value improvement plan to rectify that. And what can often fall off the back of that are governance improvements and incentive changes as well.
Great. I think all you need to do is spend a bit of time Googling and you'll see that all of the investors here are very active. I think there have been some successful recent campaigns, some less successful recent campaigns. Interested in your view as to how do you define success, what does a failure look like, and maybe some examples of some things that you've seen or worked on.
I think the most simplistic way to define success is whether you've got long-term value creation and share price. It's a very easy way to track whether there's been success in terms of adding value from an active investor perspective. In terms of recent successes and failures, I think some of the most successful ones have probably been below the radar, behind closed doors, where you might not have known about it, as Danny was alluding to earlier. I think they can be the most successful because it's constructive engagement, not a lot of media or mudslinging. They can typically be more successful. But I think in order to be successful, you can have a great idea, but unless you can convince a board and a management team to actually act on that idea, you're never going to be successful. And the way you convince people is either you have very compelling arguments and analysis and rationale to basically convince them of your view, or you have to change the board or the management to get an outcome, and that is obviously the more aggressive, typical activist approach.
Yeah, there's a clear scoreboard in terms of the success or otherwise of the investments in which we invest our clients' capital. So as Victoria said, ultimately you have a look at the time period that you held a particular investment for vis-a-vis your benchmark, which is typically the ASX 200, and that's the scoreboard whereby you can test the success or otherwise, because we have a fiduciary responsibility to invest the money that our clients entrust us with to get a return for them. In terms of success, one of the recent examples that we invested in was a company called Z Energy. It was a petrol station owner and operator in New Zealand. It was a company which had historically owned a large interest in New Zealand's only oil refinery, and as a result of that, it had significant earnings volatility over time. And it was converting that into an import terminal, which meant that earnings volatility that had existed historically wasn't going to be the case going forward. And we had meetings with the chair, with the CEO, with the CFO, and we articulated to them the benefit of holding an investor day and really articulating to the investment community at large what their investment thesis was going to be and look like going forward, and how different that was to what it had been historically. They did that. They did a very good job, and then Ampol came and bid for them and ultimately took them over. So when you ask, what do activists do, typically a lot of things we do are behind closed doors. I'd say 90% of what we do, actually takes place behind closed doors. Typically, however, when people think of activism, they think of, Carl Icahn and, I call it the sort of public capital A activism. So much of our greatest successes are actually, done behind closed doors, and at the end of the day, the share price is the ultimate scoreboard for the success or otherwise of our endeavours.
Yeah, I'd just extend on that and say, the sort of immediate shareholder value outcomes are obviously the best measure for success. We also try to, and this might sound a little bit altruistic, but try to leave companies better off than when we found them, and that's a really important concept for us, and I think for activism in general. And the common criticism of activism globally is that it's excessively short-term oriented and leaves companies strategically diminished. And the reason we chose the long-term value as the name for our fund is, we do believe that we're often advocating for initiatives or plans that will leave companies strategically enhanced. And it really does build on the credibility and the respect when you can point to past examples where you've tried to make decisions in the long term with the long-term benefit of the company. It's resulted in good shareholder value outcomes. And so when you go into the next investment and you're advocating with the next board, you can sort of show your track record and what you've tried to do with your investments.
Thanks. Maybe if I can just challenge that a little bit. I think you're talking about leaving the company in a better position than it was before you were involved, but I think typically people would see activist investors coming in and moving out, ideally once they've had the share price appreciation. Maybe Victoria, how do you think about responding to that in terms of being, although looking after the long-term benefit of the company, still being in there for a relatively short term?
I think it's an unfair characterisation.
Not mine, of course.
Never. But speaking for our fund, we've only been up and running for a bit over 2 years, but in that time we haven't exited a position. So I would argue that that sort of speaks for itself. I think others on the stage have a similar experience of holding positions for a very long period. But also the initiatives that we're putting forward, or the strategies that we're putting forward to our portfolio companies, do have a long-term lens. Our fund is open-ended. We don't have an imperative to exit over a short period, and so we can hold things in perpetuity theoretically. So we have that mindset as we're putting forward strategies to our investee companies.
Great. Now there's obviously a lot of different players when you look at activist situations. There's the activist investors, you've got some passive investors, you've got boards, you've got management, you've got regulators, you've got the press, and then you've got proxy advisors as well. And I think on the proxy side, we've seen them act both for investors when they're running a campaign, and more typically acting for the company when they are, and you'll forgive me if I say this, but defending against an activist investor. Danny, what is the role of a proxy advisor in those situations?
Yeah, it's a good question, and proxy advisors are a really important stakeholder group. They assist institutional investors in making informed voting decisions, right? They'll produce a research report, looking at the resolutions being put forward and assess whether their clients, and recommend if their clients should vote in favour or against the board recommendations. Heavily governance and policy focused. They clearly define policies which they update kind of annually. But really, there are four main proxy advisors in this market, which all engage and operate differently, slightly different policies that need to be managed throughout that kind of process. You've got ISS and Glass Lewis, who operate and cover global markets, ownership matters, and ACSI being the Australasian Council of Superannuation Investors that are here in this market alone. And they will typically cover the ASX 300 and any contested situations which activism would typically fall into, M&A and any other situations that one of their clients may request they cover. But when it comes to the contested situations, and this will be those public campaigns, 249Ds, 249Ns, shareholder proposals, board nominees being put forward at an AGM, etc. They'll try to remain impartial. They'll engage with both sides, both the requisitioning party as well as the issuer, and try and take a balanced view, and only meet after all of the materials are in public domain, so notice the meeting's been published, because that's what, certainly in the case of ISS and Glass Lewis, they'll only rely on publicly disclosed information when making their recommendations. But the reason that they're such an important stakeholder group is the influence that they hold typically over issued capital. I think when you look at the impact and influence they have over, on average, an ASX 100 company, I think Glass Lewis may hold influence over 36% of the shares on issue, ISS 34%, while ownership matters and ACSI roughly around 14% each. It's a really important stakeholder group. They hold huge influence over issued capital. But also, to that point, the institutional investors, the passive funds, superannuation funds that do subscribe to their research will subscribe to more than one typically as well. So they might receive Glass Lewis and ISS's recommendations, which means that they're, again, from a requisitioning party perspective or an activist perspective, if you can get those in concert, it's going to have significant sway in securing support or otherwise from the institutional investors that subscribe to those proxy advisors. But just last point on that is just as their client base continues to grow in terms of assets under management, where they can look into deploy capital and the strategy they're employing, the influence of the proxy advisors are going to grow as a result of that as well.
And Vid, what do you think of proxy advisors without upsetting Danny?
I mean, I think that their importance, both the advisors and to the companies, as well as the recommendations that come out from the firms Danny mentioned, have probably increased in importance in the Australian context. I think the first reason for that has been to what James mentioned before, just the rise of passive investors, who, to be frank, have done a pretty poor job of engaging with companies proactively, and so a proxy advisor becomes the default option or choice for a lot of those investors. And then the two strikes rule in Australia has weaponised AGMs probably to a greater extent, and so gives greater weight to proxy advisor views.
Great. And then more broadly, you touched on more passive funds. I think we're all seeing the market changing. I think when you looked at shareholder registers 20 years ago versus now, you're seeing a lot more passive funds as a percentage of the overall register. You're seeing superannuation funds just getting bigger and bigger and going more direct rather than via managers. Apart from the point around proxy advisors, what are the other implications? Does that give you an outsized influence on a company?
I think it can depend. I think it depends on almost that dialogue with the proxy advisor who does take an independent and impartial view. But if you can set out the case for why change is needed, it does add influence to what you're trying to do with the company.
I think, just the proxy advisors are evolving how they approach things as well. Like Glass Lewis have recently introduced a webinar service to contested situations, so to give an activist a chance to put their case forward to Glass Lewis's clients, right? Not that I'm not promoting this service, by the way, but also giving companies the chance to respond as well. So I think we haven't really seen it in Australia yet, this view, but certainly I think Disney had it with Trian in the US, and more recently City of London Investment Management and White Box Advisors in Korea, when they targeted Samsung C&T in Korea, adopted this approach as well. So it's about, say, presenting the case to try and drum up that support.
Great. Let's talk a bit about boards, management teams, etc. And I think we've all spent, or certainly those of us on the stage, have spent plenty of time engaging with public company boards. And I think it's fair to say that many of them talk openly about the challenges of being listed. It's becoming harder and harder from a compliance perspective, from a personal risk perspective, from a litigation perspective, and then trying to keep up with all the ESG changes that are coming through, etc. And I think you compare that to some private equity investors, where they probably spend 10% of the time on that, rather than significantly more than that. Do you think that is impacting the makeup of boards, and is that an opportunity for activist investor funds?
Oh, look, we do sympathise with public company directors, and do think it can be quite a difficult job being listed, and I think we've touched on a few of the points earlier, but I put it down really to three things. The first is just the public scrutiny that comes with being on these boards, and decisions are evaluated often in the public with the benefit of hindsight, and I do think at times that can lead to a lot of risk aversion and conservatism in public boardrooms. The second is just sometimes the excessive short-termism you see around the market. I think part of what drives that is having a share price that basically marks your homework every day, and many fund managers who are more focused on short-term outcomes, and then finally the regulatory and compliance burden that sits over some of these companies is quite extraordinary. And a personal anecdote, when I look at the board papers for our private investments, 90% of the content is focused on strategic issues and how to grow the company over the medium term, whereas it's a flippant comment, but I'd argue most public company board papers have an inverse proportion. And so that does create the opportunity for us, where we think we can be an influential and engaged shareholder, and give that private equity style mindset to a public company.
The other thing I would add is we can bring our networks to bear to actually attract directors onto boards that might not otherwise, that the companies might not otherwise be able to get themselves, where we're nominating or putting forward suggestions for director nominees that we think can be value additive. So I think that's part of the benefit of an engaged shareholder.
Great, thank you. Vid, you've got a catchy 2 in 2 principle that you've been very vocal about. Do you want to talk us through that? Yeah,
sure. I think in general the notion of director independence has gone too far, and it is a very important concept, but I think it's just less important for some of our large public companies. And what we'd benefit from is the stewards of those large public companies having more skin in the game and more of a shareholder's mindset. And so we think more alignment with public company directors is a good thing. And the sort of pushback or criticism we received on that proposal, we think can largely be solved for. An example is, many directors might not have the personal wealth to be able to buy shares in that capacity, and we think tax efficient structures like salary sacrificing NED fees and things like that can go a long way to getting you there. And ultimately, it's just about better alignment of incentives between all the stakeholders that sit around a public company.
Great. I think it's a good idea for what it's worth. Danny, in terms of steps that a company can take to avoid attention from an activist investor, I think the obvious one is run it very well and have a share price that's going in that direction. What else can and should a company be doing?
Look, it's a good question, and outside of strong performance, I think you might struggle to avoid the gaze of some activists, but there are obviously steps that companies can take to prepare. first and foremost, have a strong team of advisors that you can call upon in the event that you do receive a proposal or someone appears on your register that you may not necessarily like the look of, but also don't automatically become defensive about them appearing. Certainly, some of these names, have spoken very much about that long-term shareholder value creation as opposed to some of the short-termism which we might have seen some other names in other situations. And I think back to kind of Bellrock and their targeted approach to Whitehaven last year was a very short-term view from them. But one of the main steps is really to have a really strong understanding of your share register as well. As a listed company, you need to know who's going to determine the outcome of a corporate action should it present itself. So understanding who's going to determine the outcome of a vote, the influence of the proxy advisors, the superannuation funds, passive funds, how they behave, their policies, having that really a good sense, a good lay of the land there is going to stand you in good stead. In addition to that, right, frequent and ongoing engagement with those stakeholders and other market participants, but you'll need to engage with activists, hear them out. As James was saying, it's a lot of the best work in that collaboration is done behind closed doors. That's the best outcome for both company and activists, I think, rather than having long, protracted, drawn-out situations. But when I say engagement, it's being consistent in messaging as well around what your strategy and approach is, to these stakeholders, making sure that they're aware of the company story, what you're doing about things, talking about your weaknesses as well, understanding where your weaknesses are, and having a game plan to address them. James mentioned diversity as well, right? If you're going into a meeting with Hester, you need to know the diversity makeup of your board, because they're going to be attacking you if you're not talking about a strategy to get to a 40-40-20 split. Listen to what these guys are saying as well, right? They're telling you about what they look for, their strategies, their approaches, and so in the event that a name does pop up that you're maybe just a little bit wary of at first, you can war game and map out any scenario that may eventuate.
I might just add, I think the mindset of how you avoid an activist coming onto your share register is the wrong mindset. And the reason I say that is because each of Victoria, myself and Vid's funds, we're long only. We have alignment. Many of the investments in which sit in my Best Ideas Fund, we've been investors at L1 Capital in those companies for 8 or 10 years in some cases. We, by virtue of only having 10 stocks in the Catalyst Fund, I've got a laser focus on how each of those 10 stocks can improve. A typical fund might have 30 or 40 stocks in their fund. When we go and speak with management and boards, we're trying to give them ideas, give them feedback on how they can improve their share price for the better long-term, value of all shareholders. So I think, if I was sitting in a chair's seat or in a CEO's seat, quite frankly, I'd welcome having, shareholders who were engaged, shareholders who were trying to enhance the security's value over time, and bringing forward ideas and having alignment.
And it's probably the wrong group to ask this, but what are the worst things that a company can do when you turn up on their register?
I think the worst thing is to try and ignore the shareholder and just hide under the covers and hope they'll go away, because I think that's probably going to result in a worse outcome. I think I completely agree with James that by the time you have an engaged active investor on your register or so-called activist, they've done a lot of work to get there, so you should be listening to everything they have to say. I'm not saying roll over on everything because, ultimately the management team knows the business better than anybody, but that's effectively free advice from, a lot of capability that sits around on this panel and the broader businesses that we work in. And so having an open mind, listening, taking that feedback on board and actually not just trying to ignore and hope that they go away.
Yeah, I totally concur with Victoria. Engage, listen, understand the thesis that is being articulated to you. We have alignment, and that's really, really important. Ultimately, boards and management teams have their own minds, and they may ultimately choose to agree or disagree, but make that decision, after evaluating it with proper, consideration. Appoint advisors, in certain situations where it's appropriate, to fully dissect and peel back, the onion, so to speak, because ultimately, we want the share price to go up, and we've thought deeply and done a lot of independent research to put forward what we're proposing, to create value for the benefit of all security holders.
Great. So this being an M&A forum, it is worth touching on. We've seen activist investors get very involved in takeover situations, trying to block takeovers for not driving sufficient value, trying to encourage the company to look at other potential options to drive value, none of which gets a banker paid easily. Should we think of you as friend or foe?
Yeah, look, I think there is pretty serious alignment between what we look to do, the board and management team at a company, and the advisor for that company as well. And sometimes I think it's extraordinary, this concept of having to defend against an activist. It's sort of a shareholder in a company standing in the same shoes as everyone else. And if you think about a private company for a second, you'd never have a private company engage advisors to help them think about how to speak with their shareholders. And so, I do think all three parties are fundamentally aligned. I'd also stress that, activism, or particularly what we do, often can drive transactional activity in the form of corporate restructures that I've spoken about before. And then we also think we've been quite helpful in certain situations to improve the negotiating power or the bidding tension, whether that's through asset sales or where we believe the company's received an opportunistic takeover. We think we've been able to give good cover for boards to extract better value from buyers.
What we do is very synergistic with what the M&A community does, because often, as Vid said, we're advocating for something structural or something to be bought or sold, which will ultimately benefit advisors through transaction fees, which we're more than happy, for our companies in which we invest to pay, provided that, it's creating value for ourselves and other shareholders. So in the Northern Hemisphere, the question is very much focused on how synergistic the relationship is between activist investors and the advisor network. We're obviously a much more nascent, strategy here in Australia, but I think over time the M&A community will come to realise that the synergies are real and large between what we're doing and what they're doing, day to day.
Great. And I think related to that point, as we've heard about the way that you screen situations, the way you look at situations, the way you invest, the way you stay involved, respectfully, but it doesn't seem all that different between all of you. Would you see yourselves, we're certainly seeing a bit more offshore where activist investors are working together in situations. Do you think we'll see more of that in Australia and in some of the situations that you're working on?
I think, as you've heard today, we are sort of attracted to similar situations. So I think it's inevitable that we end up on registers of companies. I don't think there's any formal agreement or collusion or anything like that. But it's inevitable that we will end up on registers together because, it's not a huge market. And so there will be a handful of scenarios where we're together, but we might not always have the same view. So I think... but having said that, where we do have aligned views, we can work together to increase the effectiveness of the engagement.
I mean, it's commonly referred to as swarming, where you have a number of activists around a particular situation, as Victoria said, not by design. We're all very cognizant of the need to act independently and not be deemed associates at any point in time. But, you've heard, value as being a key gate for each of us to really look at, in the opportunities in which we invest. So often that does mean that we're around similar situations, and we'll typically, view things in a somewhat similar fashion. But we've all got our own minds, and we'll also view things differently on a case-by-case basis.
Great. I think we're seeing more competition in the activist space, a lot of dedicated local fund managers like yourselves. Do you expect that competition to increase, or do you expect there to be more activist investors here? And do you think, given the success of some of your funds, some of your campaigns, do you think that makes the Australian market more attractive to some of the larger global players who may have limited or no presence in Australia?
I might take that one. I mean, the L1 Capital Long Short Fund invests, 30% of its capital offshore, and that's our flagship fund. So we interact with, offshore investors and participants. I think the reality is we are a small market globally. We're in a very unattractive time zone. If you speak to someone in New York, they don't like the concept of having to deal with the time zone in which we operate. And when they look at the Asia Pacific region, what they see is other markets which is of a higher priority for them, such as Japan, where there's a lot of activism that's currently underway. So you will see offshore investors come here on occasion, as you saw with Elliott and BHP, but I think we are a small market where everyone knows everyone, and there's certainly some advantages to being on the ground here and having the relationships that have been developed over time.
Great. I think one of the things that's come out of this discussion is there's clearly a lot of press around some very active situations. What's fairly obvious is that there's also a number of situations that take place behind closed doors. How would you characterise those discussions? Is it a discussion behind closed doors with a threat to go public? Is it just a genuine constructive discussion behind closed doors that's always intended to stay behind closed doors? How should we think about that? Because I think everyone's got a reasonable amount of visibility over the public campaigns. You've got the websites, you've got the press, you've got the emails going out, you've got proxy advisors. Maybe just a bit more insight, and obviously not situation specific, but how you think about some of these quiet activism type situations.
I'm happy to lead off.
It's clearly not a planned question.
Yeah. It's very situation specific, but speaking from our fund's perspective, we would like to start things out on a positive note. So we don't go in there threatening and yelling and screaming. It's very much constructive engagement, building a relationship, getting to know the people and the business better. I guess it's an unspoken threat. Everyone knows, strikes at the AGM or the threat of an EGM, that it's sort of an implicit threat. Occasionally you might have to take it that far of actually vocalising that threat, but we'd prefer not to get to that point. And then obviously then that you can actually exercise your votes at an AGM or whatever and express that more publicly, or even go so far as media campaigns and the like. White papers are often seen offshore. We've done it in one situation, but it's not something that's usually step one in our plan.
One of the points I'd make is that in the three funds that are up on the stage here today, we're each a fund of scale. So when we invest in a particular company, we have not got a de minimis shareholding. We've got a shareholding of scale. And in the case of L1 Capital, we typically invest alongside the long short fund. So we've got more capital there. So that enables each of us to have a voice. And, when we go and engage with companies, front of mind for me is not this starts private, it goes to public. We're trying to engage with the company to create long-term value for us and all shareholders. So, yes, there will be situations where we go public because, we may have a $400 million shareholding out of a $25 billion market cap company, and we want to socialise the investment thesis around the market. But even the way you do that, you can do that after engaging in a very respectful and polite way with the company, because the reality is everyone talks, we're a small market, so the way in which you go about things is really important because, rest assured, as soon as you meet with a company chair or a CEO, they'll shortly thereafter make a couple of phone calls to understand other companies which you've invested in, what you're like to engage with.
Yeah, we like to call it engage on the contest of the idea, and privately to start off with. And, we do it quite transparently. We share all our research and insights with the company. And, what we really try to ask is where are we wrong? And if we do get a good answer to that, and we have in the past, we change our minds, and I think it's incumbent on us to do that as well. We socialise the idea with other investors, and so going public is a last resort. It's not a preferred approach for the company. Obviously, it's not a preferred approach for us. But where we feel that there's been generally good agreement amongst the shareholder base for our plan, we haven't received good enough answers from the company about why it won't create value, and a substantial amount of time has passed. It is a lever that we do sometimes use to try and get sort of the ball rolling.
Excellent, thank you. We will take some questions from the audience shortly, but before we do that, we usually try and finish up with a bit of a crystal ball. Maybe first, before the crystal ball, if you can let us know how you've seen the opportunity set evolve over the last 12 months, but also if you look forward, pick a time period, 12, 18 months, what you think the opportunity set is going to be, not name specific. Are there particular sectors that you're seeing as more vulnerable, or is it very much situation specific? Maybe we'll start at the end and come back this way.
Yeah, I think rather than sector specific, a theme that we have certainly explored over the last 12 months and we think will be more interesting over the next 12 is just some of the capital allocation decisions that were made in a zero interest rate world that are now coming home to roost, to use a cliche, and the opportunity to go in there and either overturn some of those decisions or make different decisions going forward. We're certainly seeing that as quite a big thematic over the next 12 months.
I think a thematic which you're going to see more and more of is costs out. I mean, we're only a few years after COVID, and the reality is during COVID there was a fight for survival, and people weren't worried about the cost bases. They just wanted to make sure they existed going forward. So what you have is a situation where all but a handful of ASX 200 companies have had meaningful or material cost out programs, and I think a lot of the OPEX lines in a lot of listed companies are quite bloated and aren't sort of fit for purpose for a go-forward environment where revenue growth is going to be tough. So I think that's a thematic you're going to see more of going forward as people seek to maintain margins. In order to do that, they'll be looking to take costs out, I think. And in terms of the sector or sectors where you may see more activity in the next 12 months, I think the resources sector is a sector which will benefit from activism, because valuations are, pretty attractive in that part of the sector at the moment. And I think there's a number of companies where, the value unlocks that, if enacted, would, create a lot of shareholder value.
The last thing I'd add is the reason activist investors exist is because all companies are not perfectly well run. And so there's always going to be opportunity, no matter the economic cycle or what's going on, where management makes a misstep, poor capital allocation, just poor decision making. So there's always going to be opportunities for us, I think, no matter what's going on in the broader economy.
Excellent. Thank you very much. We've got about 5 or 10 minutes for any questions from the audience.
Thanks, guys. For the former advisors on the panel who have become investors, what have you learnt in your new role that you wish you had have known when you were advisors that you could pass on to advisors in the room?
I thought I know everything. I'll kick off. It's a good question, Sean. So just by way of background, I was an investment banker for 2 decades in Melbourne and New York with Macquarie and Flagstaff Partners. I would have been a better advisor, like all advisors are, if I had gone and spoken more regularly to the listed investor base. Often I worked on deals that weren't, in the listed space, and then when you did work on the listed space, you should be having spoken to those investors more often, because just when you listen, you learn, And I think you can provide better advice to the companies which you're advising if you've spoken with, their investors and understand what they think. And there's obviously points in time where it's appropriate and not appropriate to do that, but just having a more regular dialogue with industry super funds, with active fund managers to understand what the hot button issues are in the companies in which they invest, that will enable advisors to give much better advice to the companies in which they advise.
Yeah, I'd add two, Sean, just from personal experience. The first might sound a little silly, which is, taking more of an ownership mindset. And I think certainly when I was on the advisory side, looking at things more from a board and management perspective than from a shareholder perspective can often be a path that advisors go down. The second is just taking a longer term mindset, and I think too often advisors look to get deals done in the short term that may not be strategically the right thing to do. And I think the advisors that can take that longer term mindset do build better relationships and more trusted relationships with the companies they advise, but they also build better relationships with shareholders over time as well. And so, whilst it can be painful to recommend against a deal in the short term, I think the long term benefits of just an advisor taking that approach are pretty strong.
So I was an investment banker for 15 years at UBS. I think from my perspective, I wish I had challenged some of the companies I were advising to self-disrupt a little more. It's easy as an advisor just to go along with status quo of strategy and how business has been operating. But I think if we can encourage boards and management teams to sort of disrupt themselves and look at the status quo and challenge whether the strategy that's been adopted is the right one, I think that would be better for all shareholders as well.
Yeah, and I would add, you never garnish more trust with your client than when you tell them not to do a deal and then you subsequently tell them to do a deal. And those clients where, it was that sequence of events where you do the right thing, which, everyone should be doing, that's where you create goodwill and that's where you create trust. And so never be afraid, as Victoria says, to say, no, this isn't the right deal, because there might be a point in time in the future when you're acting in a fiduciary capacity where you say you should do the deal, and then they know full well, you've got their best interests at heart.
Great, thank you. Any other questions?
Hi, I want to ask the active shareholders investors on the stage today. I remember Danny mentioned that there's a rise of passive investors. So I was wondering, as activist investors, have you been seeking to engage more with a wider range of investors to get them on your side, including those passive investors, maybe through proxy advisors? And if there is an engagement, how is that done? Thanks.
I'm happy to lead off. I think absolutely one of the tools in the toolkit is to engage with other shareholders, whether they're active or passive. I think typically we would focus more on the active shareholders, and that includes, large super funds and the like, who are increasingly becoming focused on, leaning into that stewardship. So absolutely getting support from a broader cohort of shareholders is part of the strategy, particularly if you're not getting the responsiveness that you look for in a situation.
I'll just add, Victoria mentions the superannuation funds obviously increasing in size, scale, investing in their kind of responsible investment and stewardship capabilities as they seek to take greater ownership of their own assets. The passive funds themselves are increasingly becoming self-aware of the role they play in the market and becoming a little bit less reliant on proxy advisors in terms of following them blindly. Not to say they don't land to the same conclusions as proxy advisors when they make decisions, but again, their rise, their growth, they've invested in their stewardship and governance capabilities. So we've seen the likes of Vanguard, State Street, Dimensional put in place stewardship resources here in Australia to engage directly with investee companies, and they will seek to, similar to the proxy advisors, they'll seek to engage with both sides in a contested situation if they see the need to, right? But they're making more, investing heavily in those engagement capabilities. So probably going to be increasingly open to engaging over time.
Great, thank you. We got any other questions? Got one down here.
I've got a question in relation to board composition. I'm just wondering whether the old boys directors club is still rife out there, where you have 60 and 70-year-old directors on 6 and 7 and 8 boards, and how you as activists would do something about that if needs be.
I'm happy to kick off. I mean, I think diversity on boards is really constructive because you want different perspectives. And, that is different perspectives both based on gender, age, background, experiences in life. Because if you all come from the same place in life, you generally will have the same perspective. So, you have seen listed company boards like, Telstra appoint, young people in their 30s, to be a director. Why? Because there's a lot of young people who are customers of Telstra, and I can see merit in that. Time on the track's really important, to get learnings of life and experience, but having a diversity of skills and experience, I think, is really constructive. What I would want, though, is with that diversity of skills and experience, them to have one common thread, and that is, to act in the best interest of maximising shareholder value. And, I think if people are at different stages of their career, there might be different motivations as to where that priority fits in the suite of priorities for them in life.
Do you think no matter how smart a particular person is, that they could adequately operate on 6 or 7 different boards?
The short answer is no, and I'll give you a case study. The year before Crown Resorts was taken off the listed boards, there was 128 board meetings for those listed company directors. Now, that's a very extreme example. It was under takeover. Every time there's a target statement, they need to issue, have a board meeting. There's a lot of regulatory consideration. So time is our greatest resource. But in that case, that's one company that was averaging well over 2 board meetings a week. And every time there's a board meeting, that could be for 2, 3, 4 hours. You need to prepare. So the short answer is no. Even if everything's going really well, the short answer is probably no. But as we all know, plenty of companies, not everything goes right. So definitely having a sensible but limited number of board directorships, I think, is a prudent thing for directors to be there to have.
And I think that's a market-wide view, right? You've got proxy advisors and other passive funds, superannuation funds, that want to see limits on the number of board positions held by these directors, with them counting a chair position as 2 board seats, and wanting to see no more than 4 or 5. With some investors even applying lower limits than that, even 3.
Thank you. It's a great question. I've got time for one more question if anyone's got one. I think people are hanging out for a coffee. So I think it's a break after this. But if we could please thank the panel for their time today.